Welcome back to Asian Century Stocks. I'm Michael Fritzell. Today I'll give you a short macro presentation, talk about some trends that I'm seeing in the region, and also what risks that are associated with these trends. And that's why I named the presentation "There Will Be Blood," because clearly there will be losers and potentially also winners, ways to play it, if you will, in terms of the trends. None of this discussion should be taken as investment advice. It's purely for information and educational purposes. Speak to a financial advisor before making any investment decisions. So I named this presentation "There Will Be Blood," and that's named after a 2007 movie about an oil man trying to win at all costs and wreaking a lot of havoc in the process. Now, these trends that I'm seeing in the region, including the Chinese property market, are going to have significant impacts on equities, not just in Asia, but also across the world. And let's talk about them one by one. So today's agenda will include a discussion about Japan's yen carry trade and the unwinding of that, or at least the partial unwinding that we saw a few weeks ago. Then I'll discuss the Chinese property market and the deflationary trends that we're seeing, and then talk about electric vehicles, including Chinese auto exports, Malaysian FDI, which is really that is foreign direct investments into Malaysia, which is one of the key beneficiaries of the reduced greenfield investing that we've seen into the People's Republic of China. And then finally, let's talk about Vietnam with the leadership change that we saw a few weeks ago. So let's start with the case for Asia. Everybody knows U.S. market has performed exceptionally well, and that's for a good reason, because U.S. tech companies have done extremely well in terms of their earnings growth. The Mag 7 in particular have really outperformed, but the market is also becoming frothy, and outside of those 7 stocks, the earnings growth hasn't been all that high. So why are they trading at much higher multiples than in the rest of the world? Well, that is very problematic, especially when the US dollar is as expensive as it is, and valuations, as you can see here in terms of CAPE ratio, are exceptionally high in the US. So that's partly related with growth. Investors right now are favoring growth because it's been easy to find growth in these tech companies that were kind of perhaps partly enabled by the smartphone app stores, but also just the internet and shifts in consumption patterns and the subscription economy and so on, which I'm also benefiting from. But there's a limit to it. And if you look at the EPS growth of growth companies, it hasn't actually outperformed. That ratio is kind of flattish, yet the ratio in between stock prices has gone up. So we're clearly in a bubble, and that's going to reverse at some point. It's only a question of when. Now, the US dollar is starting to break down, at least on this chart here. And who knows about technical analysis? It doesn't always work. But the fact of the matter is, if we do get a Trump presidency in November, he's clearly favoring a weaker dollar. He's favoring lower interest rates. And that is a clear risk for the US dollar, because clearly purchasing power is weak. And the dollar seems to be very expensive on most metrics. If we do see lower interest rates, which is what's been holding up the dollar so far, we could finally be seeing a weakening cycle. And typically what happens then is that you get outperformance of international assets. You also get outperformance of gold, silver, platinum, these kind of precious metals. And then flows will kind of follow performance typically. So we haven't seen flows into Asia for a long time, but perhaps it's finally going to happen with a weaker dollar. That's my expectation, at least. So MSCI Asia ex Japan has been flattish. There's been no real interest or big movements, really. It's not a frothy environment, no excitement, but there are individual stocks that are very cheap. Japan has been a favorite market by retail investors. You can feel it on Twitter. There's been a lot of discussion about Japanese equities, small caps and such. But to a large extent, especially the Nikkei has benefited from the weak yen. And that trend is basically over at this point, I think, with the yen bottoming out at about 162 to the dollar. So the carry trade unwind that we saw in early August, that's that is driven by something real. But honestly, I think that we're not going to see a much weaker yen from now. So if you want to bet on the Nikkei, or if you want to bet on the Japanese market as a whole, that the tailwind in terms of the weaker yen is simply not there anymore. So personally, I'm looking at service companies. I'm looking at companies that are importers into Japan, because I think the strengthening is going to happen. It is not a frontier market currency. There's no big budget deficit. The money supply growth is very limited. So this is all about the US-Japan interest rate differential, and that one is narrowing. Now, in terms of Chinese equities, they've outperformed recently, but very weak overall. Like Hong Kong equities are so cheap. You can see that here. Hong Kong equities trading about 10 times earnings next year. And then Philippines 11 times, Singapore 12 times. Those are the cheapest markets. Korea also looks cheap, but it's always been cheap. And the return on equities is exceptionally low there. So I don't see that changing anytime soon. So to summarize, I think the US market is very frothy. It's been the case for a few years now, but a weaker dollar could be a good reason, frankly, for flows to move out of the US. Or even people in Singapore or Indonesia, they're also investing in US stocks like Tesla and such. So we'll see how long growth stocks will remain in a bubble, but I will certainly not touch stocks that trade at such multiples. Asian markets not frothy at all, except India, of course. And the cheapest markets, in my view, are Hong Kong, Philippines, and Singapore. So let's talk about Japan. I was in Tokyo a few weeks ago, and the biggest takeaway is just how cheap the yen was. I think at the time it was trading at 158 to the dollar. And as an example, I had this gyudon beef rice, let's say. And it cost about 460 yen, I think, about less than $3 and very filling, enough for a lunch that will keep you full until the evening. And that's frankly extremely cheap, even compared to Singapore, less than half the price, easily. And I bought this lunch in Shinjuku, which is right in the middle of a train intersection. So prime area. And nothing special at all, but just very cheap. And you see that across the board. Now, a few weeks ago, you saw this rate hike to 0.25%, 25 basis points. And there was also a planned shrinking in the BOJ balance sheet. So quantitative easing is over. And that led to a massive strengthening of the Japanese yen. And the impact then was massive in terms of the Nikkei 225. And it retraced the decline somewhat. There was rumors of big losses among some investors in Asia, but I wouldn't expect there to be a full further weakening beyond 162, because the US-Japan interest rate differential that you can see here in the black, it's already peaked, I think. And the reason is twofold. Of course, Japanese interest rates are going up a little bit, but primarily the US interest rates are probably going to drop very soon. At least that's what's priced into the Fed futures market, Fed funds futures market. But then, so why is that the case? I think the money supply growth that we saw during COVID, that excess has basically been removed, and there's less money sloshing around, and the US job market is weakening at a slow pace, but it's going up slowly. And typically when that happens, you will see a recession. That's what we've seen in the past. People are, as they lose their jobs, they'll stop spending as much on vehicles and such. And the inflation rate ex shelter is about 2%. There's a lag in the shelter component about 18 months. So by April 2025, you're going to see headline CPI as well dropped about 2%. So my guess is the Fed it has dual mandate, but it will stop caring as much about CPI, about inflation, and will shift its focus to the unemployment rate and the employment. And so we'll see. But certainly the inflation pressures are not quite there anymore. So I think that means a stronger yen over time. Doesn't necessarily mean that the Japanese market will go down, but I will certainly not bet on exporters. There will be blood in those in that segment of the market. And that probably means the topics will do better than the Nikkei, and service companies, importers and such will probably do better. So that's what I'm predicting. Now let's talk about deflation in China. It seems to be never-ending series of bad news. So what are they up to, these policymakers? And looking at the credit growth, it just keeps getting worse and worse. So you see the total social financing here going in black, decelerating further. The bank loan growth is going negative, is decelerating as well. Part of the issue is consumer confidence is weak, even despite these COVID restrictions being taken away. But I think that's because the zero COVID policy, it happened concurrently with the weakening of the property market. For us to crack down, and then a reduction in mortgage lending and such, causing property prices to eventually drop. I think the government bond yield continues to go lower, and that tells you a very clear conclusion that the growth is weak, and that means also probably earnings growth is going to be weak for the listed companies in nominal terms. Now we've seen 4 quarters of deflation. Here is this chart is from Jefferies, Chris Wood, and he's using the GDP deflator because that's a better measure of inflation. You can also look at PPI, but it's negative, right? So we're seeing deflation in China, and that means deleveraging. And government is trying to spend, the central government is spending, but it doesn't seem to be enough. Local governments are running out of cash because they've been relying on land sales, and that's no longer a source of income. So they can't spend as much. So now we're seeing this deflation and also showing up in asset prices with the home prices falling in the past 2 years, and that fall is accelerating, and that means a negative wealth effect. We're going to spend less on, for example, luxury goods, and these are from earnings calls and earnings releases, showing that everybody's reporting very weak luxury goods market, and I would not touch anything luxury, frankly, right now, because there's a negative wealth effect. Consumer confidence is weak. They're deleveraging, and aspirational clients are particularly hit by these falling property prices. So why aren't they stimulating? It seems like Xi Jinping, he's resisting measures to stimulate consumption. He sees them as wasteful, and that's an understandable perspective, but that just means deleveraging, just like we saw in Japan post-1989. Instead, loans are going towards manufacturing, which then leads to excess supply of manufactured goods. And that's what I'm going to talk about later about EVs. And investors are seeing that, so they're moving money into India. They're moving money into Korea because it's a large part of the MSCI Emerging Markets Index. And that's it's also been tech has done well with rising DRAM prices and such. But so this is a trend, and who knows whether it's going to reverse? Maybe not. I mean, with credit growth being this week, no really good news coming out of China, frankly. I can see why. And also there's the fact that you've seen a lot of dilution in the past 20 years. So even though earnings have been strong in MSCI China, frankly, because of dilution, the EPS growth has not been impressive. So I can see why people are a little bit concerned. To summarize, growth is just quite weak. And the issue is credit growth. And there's no really stimulus. There's always hope for stimulus early in the year when there's a huge amount of credit disbursement of loans. But typically we also see a disappointing numbers towards March, April, May. And this year has been no exception. And the GDP deflator showing clear signs of deflation, also asset prices are falling, leads to, since loans are given with the property as collateral typically, you're seeing reduced creditworthiness and just deleveraging. So that's negative for the luxury goods market. Now let's talk about electric vehicles. I wrote about the platinum group metals recently, and that's one of the themes that I think are interesting. That's I think consumers are moving away from fully electric vehicles to hybrids, and that should benefit the platinum and palladium. But let's talk about EVs. So in China, we've seen from 2014, we've seen consumer subsidies, massive subsidies, and they've been removed slowly, but it helped boost the EV market going from zero in 2013 pretty much to becoming what it is today. From 2019, they kind of put the policy into high gear, pushing ride-hailing companies to use electric vehicles. And then the NDRC, they ordered local governments to remove license plate restrictions for EVs. So let's say in Shanghai, you pay 140,000 RMB for a license plate. If you buy an EV, the license plates cost nothing. And obviously then you will be much more inclined to buy an electric vehicle, even though the price is slightly higher. But there are also cheaper electric vehicles like mini EVs and such that don't cost as much. And we're also seeing we've moved away from consumer subsidies towards supply measures with these NEV credits and CAFC credits. And they are incentivizing supply. If you're producing ICE vehicles, you're being punished essentially. And if you're producing EVs, you don't have to buy these credits on the market. And that's incentivized production of EVs, extra supply, and some of that supply is being exported. Now, there's been a talk about the Chinese auto exports being just booming, and that's partly true, but most of these vehicles are not EVs, and they're not Chinese brand vehicles. They're mostly foreign brand vehicles. There are some BYD cars being exported, of course, and MG and such, but most of the vehicles are basically Japanese brands being exporting out of, let's say, Guangzhou, because they're not selling as well in China anymore. There's nationalism, and there's also a move towards EVs, which they're not particularly strong in. So we're seeing Japanese exports from China. We're seeing Tesla exporting from China, and that shows up in these numbers here. So it's a bit misleading to say that China is just repeating the 1970s miracle of Japanese auto exports. Could happen. But I think that's highly misleading. And we're also seeing an inventory pileup of EVs in certain markets like Belgium, Thailand, and so on. I also think that we're seeing inventories on dealer lots, and seeing that in the numbers in almost every market. They're just quite hard to sell. These numbers here from Nikkei saying that Thailand has 500,000 unsold EVs, 63% of all the production over the past 12 months, which is massive. And so there's a lot of exports and a lot of output of electric vehicles. But do people like them? They're okay, probably, but they're being pushed onto consumers. And it's not so clear that if there isn't any push from the government, that people are going to buy them. So US consumers seem to be becoming more skeptical about them. Part of the issue is cost. Also, part of the issue is charging infrastructure. So why should we be skeptical about fully electric vehicles? I think cost is quite high. Maybe they cost at least $5,000 extra than a hybrid, and they depreciate twice as fast as an engine. So that's problematic, frankly, because these are quite expensive, these batteries. So $7,000 at least. How are you going to make up for that? So charging times are longer. The attractiveness of charging stations are not that, they're just not that great. So if you want to wait for half an hour or an hour, that's just a waste of time, isn't it? So normal price EVs have pretty low range. Perhaps that's improving, but it has to improve, because if you're going to get on par in terms of the convenience, it's going to require a lot. Now, CO2 emissions profile, it can be better for EVs, but it's not materially better. And frankly, if you want to improve CO2 emissions, you need to reform zoning laws to make sure that there's a high density of living in cities, and just push public transport, because that's what really removes CO2 emissions, along with nuclear power plants. But there's no such discussion, which makes me think that this is all very very politically driven. So there are also fire hazards, because you can't put out an EV fire that easily. And also geopolitical concerns, of course, with these supply chains really being reliant on China. So, but even in China, I think hybrids are becoming more popular. You see that here, 2023, hybrids sold better than they've done in any years in the past. So consumers are just voting with their wallets. And that's probably positive for platinum group metals, showing that there will still be demand for catalytic converters. And it could also be positive for Astra International in Indonesia, which is the distributor of Toyota vehicles in Indonesia. So yeah, the governments around the world, they're adopting these almost like Soviet-style 5-year plans into pushing electric vehicles. I'm not sure whether this is a particularly good idea. Consumers, at the end of the day, they have to accept them. And unless the technology improves a lot with solid-state batteries, this is just going to be a very hard sell and very expensive for government to push them as well through subsidies. So I think it's fundamentally positive for hybrids once they realize that CO2 emission profile isn't materially better for fully electric vehicles. So hybrid vehicles would certainly be positive for PGMs and Astra. Now, Asia, let's talk about Malaysian FDI. Asia has become the manufacturing hub over the past 35 years. And for good reason, because typically the education is highly educated, they're hardworking, infrastructure is excellent, especially in China. And there's also a hub effect. So if you produce an iPhone, assemble it in China or Vietnam, then obviously if you have 1,000 components that need to be delivered to that factory, it's helpful if those distances are very short. So Taiwan is nearby, Japan is nearby, Korea is nearby. So that's why East Asia has become this kind of hub for electronics manufacturing and also other types of assembly and manufacturing. So that's not going to change. But now that China is turning inwards again, FDI is turning negative. Greenfield FDI in particular is just not being made anymore in China. So I think multinationals are realizing there's no point really producing in China anymore with the environment becoming more hostile. And they're looking elsewhere instead. And ASEAN region is the prime destination. The problem is salary levels might be slightly lower, but the infrastructure sucks. And there's also not much talent in terms of the depth of the talent pool. But certain companies are slowly moving their manufacturing operations out of China to countries like in Southeast Asia and India. I think India is one of the beneficiaries, but it's a huge country. And with the large population, it's just not going to move the needle that much. Whereas for Malaysia, this greenfield FDI is massive, absolutely massive. It's small population of only 34 million people. So the impact is going to be huge, especially around certain regions like Penang. So you can see here, well, it's not obvious, but clearly the greenfield investments into China are falling rapidly and then going up significantly, both in Malaysia, India, and also in developed markets themselves, like the United States of America. So these are some headlines about new factories opening up in Malaysia, like Texas Instruments in KL and Malacca. Haitian International they set up this factory in Johor, and then Infineon with a factory I think just outside of Penang. So why is that? I think part of the reason that the ringgit is so weak right now, and compared to the Singapore dollar, certainly the ringgit is exceptionally cheap. So labor costs are low. Infrastructure in Malaysia is excellent generally. So it is a real alternative to manufacturing in China and also Vietnam, although it's not quite as cheap. But you're seeing numbers in terms of export volumes, they're booming. And that's fundamentally very positive for the Malaysian economy. And we're finally starting to see the ringgit strengthening a little bit. And we haven't seen that for so many years. So finally, there's some excitement about Malaysia. And it's been a long time coming. But I think it's for good reason, because it can become a manufacturing hub if it isn't already. It already is to some extent, with some decent talent pool. So yeah, this is one of these trends, and I think there are ways to play it. But certainly, the Malaysian stock market is interesting. It's also going to be possible to trade Malaysian stocks from interactive brokers very soon, from what I hear. Finally, let's talk about Vietnam. There's a new general secretary of the Communist Party in Vietnam, and his name is To Lam. He is taking over from Ian Futrong. Sorry if I'm butchering that, but he was the previous Communist Party head of the party and general secretary. So what does this mean? It seems like he will be leading Vietnam into a more authoritarian direction. Vietnam used to have checks and balances with 4 individuals at the top, balancing out the power dynamics. Now that's no longer the case. This To Lam, he's both general secretary and president, and most likely he will stay in power after 2026, when he should retire, really, according to the rules. But so there are many similarities with Xi Jinping, and he doesn't seem to have a clear ideology. Neither did Xi, frankly. He seems to be very comfortable with Vladimir Putin and Xi Jinping, and the Politburo is now stacked with his allies. So what do we know about him? Well, he has background in public security, and his family is involved in business. But other than that, most likely he will consolidate power and turn the country into more authoritarian direction. And I think this recent meeting between China and Vietnam is important because this To Lam, he said, "I'm willing to establish a good working relations and a personal friendship with you and jointly lead the creation of a China-Vietnam community of a shared future," which is, it's a way of saying that he wants to join the partnership with China in terms of building trade relationship, but also political relationship together with Russia, China, Iran, and these countries. So if you believe that the new Iron Curtain is being formed, or Bamboo Curtain, that is important, I think, because if we do get barriers being introduced, like barriers to entry for individuals, like we saw during the Cold War, or restrictions on capital moving across borders, like we've seen in Russia, then perhaps it's best to stay on one side. So, for example, Singapore and the Philippines are probably more allied with United States. Free capital flows. There are certain risks then if you are investing in Vietnam, let's say in Vietnam property. How are you going to get your money out at some point? There are capital controls in Vietnam, just like there are in China. And to me, I think that's a very important trend. Certainly myself, I'm quite cautious about Vietnam, both for corporate governance reasons, but also for political reasons, like I mentioned here. So let's talk about final conclusions. I think that a key trend that we're going to see is lower US interest rates, and fundamentally it's going to be positive for Asian flows. Typically that's been the case, and it's going to be more positive, I think, also for the Japanese yen in terms of that strengthening. In Asia, Hong Kong, Philippines, Singapore, to me, look the cheapest, P ratio of 10 to 12 overall. And like I said, the yen will benefit from a weakening dollar. But there are many other currencies in Asia that are very cheap, like the ringgit is also very cheap. In terms of China, it continues to be mired in deflation. That's maybe positive for the government bonds. I'm not sure. Negative certainly for luxury goods sales, and this negative wealth effect has an impact on a broad variety of consumption goods or spending on wealth management products or what have you, or even tourism overseas for Chinese. And in terms of electric vehicles, I think hybrids seem to be favored, not just in China, but across the world. And if that's the case, then platinum group metals could be a way to play that. And then also in terms of FDI, the fact that it's moving away from China into India and Malaysia should lead to certain upgrading consumption for the new factory workers who move from farms to factories and start to buy vehicles and such. Positive for Malaysia, frankly, and positive for India, although stocks in India are very expensive right now. And then finally, Vietnam is turning more authoritarian and perhaps becoming much more of a closer ally to China. That's what many analysts are predicting. So that's where the blood will be. And on a positive aspect, I do think that in many parts of Asia, there are exceptionally cheap stocks, in particular Hong Kong, Singapore, and the Philippines. And that's really my main focus right now. And if you're interested in learning more, just go to asiancentrystocks.com, which is my Substack newsletter. And recently I talked about the stocks here listed on the right, like dairy producer Yakult, luggage company Samsonite and such, which is listed in Hong Kong. So I write 1 or 2 times per week. And, if you're interested in more content like this, just go to the website or send me an email, and I'll be happy to speak to you. Thank you so much for listening, and I'll speak to you next time.